Good morning, options traders. Welcome back, everybody, and happy Wednesday to everyone. And I've got another good question for the group here. Why do options have square root pricing? You've heard me talk about this in many videos, this square root pricing relationship, and I've had some people in the past say, why is that? Is it because the market makers are trying to give you a better deal for buying longer dated options, or the SIBO is trying to encourage you to buy leaps? All kinds of theories about that, and it really has nothing to do with people. It is far more this mathematical property behind it that is causing this relationship. So this is a little bit more technical than most of the other videos, but you'll get some good takeaways from it that can help you to make better decisions. So it's actually quite interesting, so let's dive in and find out, why do options have square root pricing? And as always, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So let's start off with a quick review of what this square root pricing is, maybe for people who haven't seen some of the previous videos. So a basic example that I like to give is that if you have a 1-month option trading for $1, what would the 4-month option be trading for? So notice we have 4 times the amount of time on this second option. So what you want to do is just to find out how much more time is here. Again, there's 4 times the amount of time. And whatever that number is, you're going to take the square root of it. So that's why I made it this nice 1-to-4 ratio here. Square root of 4 is 2. This is the key. So if we have a factor of 4, square root of 4 is 2, that tells us that over here on the right, that the second option is going to be 2 times the value of the first. So if the first option is trading for $1, you would expect this one to be trading for $2. And you'll see if you go to a pricing model, that will be true. Now you'll have to put interest rates to 0, otherwise you start getting a cost of carry component to creep in there. But it will still basically be true. In the real world, it will be mostly true, because we have skews. They're not going to be priced exactly according to this. Depends. Sometimes there's just more buyers at this 4-month option or more sellers. We can get skews. But because of calendar spreads and diagonal spreads, that's what typically brings them back into this relationship. So if this first option instead were trading for 3, the second one would be 2 times the amount, or about 6. So again, it's twice as much money, not because there's twice as much time, but because there's 4 times the amount of time. And that's what we usually call this square root pricing rule. So once again, some traders were saying, well, why is this done? Are the exchanges trying to encourage us to buy longer dated options because we're getting cheaper units of time? Well, no, it's got nothing to do with that. It's really a mathematical principle, and it applies in a lot of different areas. So let me give you a few examples, things you're probably quite familiar with. Some of them you won't be, but it's not exactly for the same reason that we get this square root pricing rule, but it will help you to understand the concepts. So let's start with, let's say if we have a rectangle. Let's go back to some basic geometry here. Let's say it's 1 unit high, or maybe 1 foot high and 2 feet wide. So everybody knows that the area here would be 1 times 2, or 2 square, in this case, feet. But let's say that we wanted to scale this rectangle by a factor of 2. I want to make it twice as big. Well, notice if I do that, I get this. The vertical distance here is now 2, but the horizontal is now 4. See, I doubled the vertical distance, but I also had to double the horizontal. So now the area is 2 times 4, or 8. So you can see that going from the first rectangle to the second is an increase of 4 times the area, even though we only doubled the size of the rectangle. So notice that if I scaled the first rectangle by a factor of 2, the area goes up by 2 squared, or 4 times. So again, 8 is 4 times bigger than 2. So part of what you're seeing here is that whenever you start scaling, especially two-dimensional shapes like this, that they're going to go up by the square, because you're increasing the vertical distance and the horizontal distance. You're doubling it twice. So watch what happens if we go back to the original shape and I want to scale it by a factor of 3. Now what happens? Now I get this. Now I get 3 units high, or let's say 3 feet high and 6 feet wide. And so 3 times 6 would be 18. And notice that 18 is 9 times bigger than 2, and that's because we scaled this by a factor of 3. So 3 squared is 9. We know that that area is going to go up ninefold. So once you understand that rectangles or squares will have their area increase by the square of the scaling factor, we can see the same thing for triangles. So let's go back to our original rectangle here, and notice that we can split this in half. Put a diagonal cut right between them, we get 2 triangles. So if rectangles scale out by the square, then triangles must increase by the square. And if you go through the math, you'll see that that is in fact true. Once you understand that triangles increase by the square, we can apply it to circles. Now with a circle, we don't really have just an up, down, or a left, right direction, but in a way we do. You can figure that if we double the size of it, we're really going off in a lot of different areas, but the concept is the same. So if we know that triangles increase by the square, I can cut up a circle into lots of little triangles. And the smaller we make these triangles, the more we approximate the circle. So now we can see that circles will increase by the square. And that's why, if you look at a circle's circumference, the distance around it, the formula is 2 pi r. R is the radius, the distance from the center out here to the circle. But if you want to know the area, it is pi r squared. We have to, again, square it. If you've had physics, you might remember a thing called the inverse square law. And that says, in one instance, if you double the diameter of a rope, it will pick up 4 times the load, not 2 times. Doubling that diameter, that distance across, increases the load 4-fold. Okay, so now we're seeing again going up by the square. At a theme park, if you're on a roller coaster, if you want to double your speed, let's say of this cart here down at the bottom, you don't make the distance here twice as high, you make it 4 times as high. You need 4 times the kinetic energy to double your speed. So be careful if you're one of these fast drivers out there. If you double your speed, it takes you 4 times the distance to stop, not twice the distance. So my point is that this whole idea of scaling out by a square, or going in the other direction, a square root, applies to a lot of different phenomena. So if we look at it with light, you might remember this from physics. If we have, let's say, a little light bulb over here, and it's got a certain amount of light, we could measure this. Let's call it this orange square right here. If we double the distance, okay, we have a radius of 1, we go to a radius of 2, the area is now 4-fold. So the amount of light on this orange square is now divided up by 4 different sections. It's 1/4 the amount. So the intensity is now the energy divided by 2 squared, or divided by 4. If you go out to a radius of 3, we get an area of 9. You can see it right here. So the amount of energy falling on that square is now 1/9. So it's energy divided by 3 squared. So you can see that this happens a lot. And what I'm trying to show here is, I think this is a good graphical representation of it, that when you have, let's say, light moving through space this way, there's just a lot more places for it to go. As you start moving away, we had only 1 square here where it could all land. Now we have 4, and we have 9. There's just a lot more places for it to go, and that's probably the simplest way to understand what's happening with stock prices. So here's a simulation in Excel, and I've got about, looks like 6 or 7 different simulated paths. We have 400 trading days. We're going to start them all with a stock price of 100, and we're just going to turn it loose. Now this doesn't include any news or anything like that, earnings, it's just volatility. That's the only thing that's driving it. And just like with a coin flip, you can flip a coin 100 times, you're not going to get exactly the same sequence, even though you would get roughly 50 heads each time. And that's what's happening here. They're not going to be the same sequences, but most of them, if you start at 100, most of them will land at 100. Why? Because there's now so many more places that these stock paths can go. Think of that light example. It doesn't just go in a straight line up. They can go in lots and lots of places. So it's this idea of having a cancellation effect. If these were coin flips, sometimes you'll get heads and sometimes you'll get tails, which tends to negate it. Think of it as if you're betting a dollar to win a dollar. Every time it lands heads, you gain, but every time it lands tails, you subtract. So if you imagine if you're flipping this coin for money, you're not going to just sit there and get gains. It's going to kind of back and forth. There's a lot of cancellation going on. However, the more time you sit there, the more it could drift. So take a look at what's going on here. Now again, these are simulations. This is not contrived data. This is an actual simulation. After 100 days, remember they all started at 100. So it looks like up here that we had a high of about 120 and a low of around 80. So let's call it plus or minus $20. So we could call that the variation or the volatility. But notice what happens if we go out 4 times the amount of time. Now it looks like our high up here is about 140 and the low down here is around 60. So now we're roughly plus and minus $40. Back here we were plus and minus $20, but it took us 400 days to finally get to where we could be plus or minus $40. It took us 4 times the amount of time to double this range. And that's the key insight. Because there's so many more places the stock path could go, for better or worse, it also allows us the possibility to have more on the high side. And that's what you're paying for with the call options or for the downside for the put options. But if it takes you 4 times the amount of time to have that possibility to double that option's value, again, that's going to happen with 4 times the amount of time, not twice the amount of time. So this whole idea of having, I like to call it more places to hide, just as you start expanding this area, it shows up in a lot of different areas in math. So you might find this interesting. If you remember from some basic math, how do we find the number of subsets? Let's say we have 2 things. Maybe these are cards. Let's call them A and B. How many different ways could you pick from these cards? Well, I could choose A, I could choose B, I could choose both, I could do nothing. So there they are. I could choose A, B, I could choose both, and this little guy over here is called the empty set, just means that we choose to do nothing. Now you might think, well, wait a minute, couldn't I choose B and then A? Well, those are actually what are called permutations. It's still the same set, what we would call the same combination. So there's 4 different subsets if I have 2 things to choose from. But watch what happens if I double it. Now I've got A, B, C, and D. How many possibilities are there? Well, I could do A, B, C, D. I could do A, B, A, C. I could do A, B, C, A, B, D, all kinds of combinations. So here they are. We have to remember our empty set down here, doing nothing, but there are 16. So if I have 2 things to choose from, there are 4 possibilities, 4 different subsets. If I have 4 things, there are 16. Notice to go from 2 to 4, I go from 4 to 16. I've increased it by a factor of 4, even though I've increased the number of things to choose from by a factor of 2. What about the number of combinations? This is where I have a number of things. Let's go back to our cards, and let's say that I'm going to choose 2 things. That's part of the problem here. I have to pick 2. Well, if I only have A and B, there's only one way to do that, and that is to pick A and B. Now again, I'm not counting B and A as something separate. That's again a permutation. It's if I'm choosing 2 things, that's the only set that I can choose is A and B. But watch what happens if I increase it twofold. I've got A, B, C, D. Now the number of combinations, choosing 2, remember I can only choose 2, are these. I've got 6 of them. So now it looks a little bit like I get 6 times the amount of choices by doubling the amount of things to choose from. But that's just because these are very small sets. So watch this. Here are the ones we just saw. If I have 2 things, that was with A and B. There was 1 combination that was to pick A and B. If I double it to 4 things, there were 6. So going from 2 to 4 increased me by a multiple of 6. What would happen if I double it again to 8? Well, now there's 28 different combinations, and 28 divided by 6 is now 4.67. If I double again to 16, there are 120 combinations. And if I take 120 divided by 28, 4.29. And look what happens. We start to converge on exactly a factor of 4. So the thing to really understand is it's just this idea that there are so many different combinations as we go through time. And because there are so many different combinations, there's a lot more places where these stock prices could hide, so to speak. They could go up, they could go down, they could wiggle back and forth. There's a lot of cancellation going on, but there is always this possibility to drift. But it's not going to just drift in a straight line. So that's what I've done here in this Excel sheet. And I've got flipping a coin 100 times. This blue line is counting just the heads. We're not penalized for landing on tails. And that's why sometimes we can go sideways. If we're getting tails in here, it's not adding to our total number of heads, but we never go backwards. We never drift lower. And we can see this is not how option pricing works. Because of this random process, we tend to get this cancellation. But right here, I'm doing it without any possibility for cancellation. So after 100 flips, we should get pretty close to 50 heads. So this blue line is just counting the number of heads, the raw number of heads. The orange line down here is looking at a bet, where you're betting $1 to make $1 at the flip of a coin. So now we are introducing the possibility for some cancellation. Now we are penalized for landing on tails, assuming that we're betting on heads. So you can see right here that after 100 flips, we only have a net increase of about 10 heads. We were only able to drift 10 units away or 10 heads away from our starting point, but it took 100 flips to do that. So notice that the square root of 100 is 10. So once again, that's really what's happening with stock prices. The fact that we can cancel, because stock prices can certainly fall, it becomes harder to drift away. It just takes a lot more time. So watch what happens. Let's try another simulation, and we'll do, now we got minus 10. That would be just the other side. We're saying that now tails we had more tails in that simulation. Blue line, again, roughly up near 50. Here we went just sideways. Again, sideways. Here got up to 10, just a little shy of 100 flips. Got down here to minus 10. And so that's really what's happening with the stock prices. We had a net difference of 0 at the beginning. If we want to have a 10-fold increase, 10 units away or 10 heads away, we need 10 squared or 100 days. Or if we have 100 days square root, we would expect to have a drift of 10 units. And that's really the best way to show what's happening with your stock prices. So in order to double an option's price, you're going to need 4 times the amount of time. And the reason is because of this ability to cancel when we are being penalized for landing on tails. So what can we take from all of this? Well, there's a number of different takeaways. First, as option buyers, give yourself time to be right. You're getting cheaper units of time. Now, yes, you must pay more money in total, but for 2 times the price, you're getting 4 times the time. See, your price per unit of time is cheaper. So going back to the earlier example, if a 1-month option costs $1 and a 4-month option costs $2, notice that you are paying $1 per month for the short-term option, but you're paying 50 cents per month for the 4-month option. And unfortunately, traders just look at the price and they say, oh, the 4-month option is twice as much. Well, that's the wrong way to look at it. Per unit of time, it's half as much. You're giving yourself a much better chance for those prices to drift in your favor. So sometimes it means, even though it can be scary, buy the longer dated options and give yourself a good chance of being right. So the square root pricing principle can also help greatly with options strategies. Is it better to sell longer dated options, shorter dated ones? What should we do? And to make those decisions, it helps to understand this square root pricing rule. So let's look at that. What about the option sellers? Well, all things equal, you should sell shorter dated options. But be careful, I said all things being equal. So if you do that, if you sell shorter dated options, yes, you will collect more money over time, but the hedge will be smaller. So you're not going to have as much of a downside hedge. That's why it's a little bit tricky when you hear covered call sellers say, oh, I always want to sell these little 3-day options or 5-day options, pick up these small amounts of money. Well, if the stock takes a big hit, falls by 5 or 10%, you're not going to have much of a hedge. So that's why we have to be careful and say all things being equal. We want to make sure we get a good balance. But all things equal, let's go back to this example here. So you can see that if you sold, let's say, 4 one-month options for $1, that's $4 you'd take in, as opposed to selling 1 4-month option for only 2. So the 4-month option, you would collect $2. That's just the initial premium. But the 1-month option, assuming you sold it 4 times, you would collect $4. You've collected twice as much money because of the square root pricing rule. So again, all things equal, you would want to lean towards selling shorter dated options because of this pricing relationship. The time is much more expensive per unit of time on the short end of the curve, and that's generally where you would want to sell. But when it comes to strategies, people get hooked on the total premium, and that's why they want to sell a 6-month or a 9-month option, not realizing that it's actually very cheap units of time. That can still be a very good strategy if you're looking for the downside hedge. But the main thing to take from all of this is that's why you have to understand this square root pricing rule. You cannot say it's better to buy longer dated options or shorter dated ones. It depends on what you're trying to do. Or that it's better to sell shorter dated ones and not longer dated ones. It depends on what you're trying to do. But hopefully by understanding this video, maybe it will give you some good visuals and ways to remember why that there's this square root pricing relationship. It has nothing to do with the market makers and the SIBO. It's strictly with the way that random processes work through time. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsa2z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.